Do you believe that the Chinese stock market, which is one of the worst performing in the world, can make a comeback over the next 12 months? Well, I believe so, and watch this video to find out why. Hello folks, today's video is about the big elephant in the financial newsroom this week, and that is China unleashing a slew of economic stimulus targeting everything from real estate to stocks to the impoverished. I'm going to go over what has been announced, what it means for the markets, and finally, my favorite Chinese Hong Kong stocks right now. Alright, so the Chinese financial authorities have announced a whole bunch of both monetary and fiscal stimulus measures to prop up the economy. The monetary measures include interest rate cuts, reserve ratio requirement cuts, mortgage rate cuts, and the PBOC is now going to buy equities. Fiscal measures include capital injection into banks, sovereign debt issuance, and helicopter money or handouts for the poor. Now, the biggest monetary stimulus measure was the interest rate cut, specifically the cut of 30 basis points to the one-year policy loan rate, which was the biggest ever cut made by the PBOC, or the People's Bank of China. This is bullish for equities because it lowers the cost of capital. If capital becomes cheaper, it means more of it can be borrowed by investors, which will directly or indirectly boost the value of local equities. Another action taken by the PBOC was to reduce the reserve ratio requirement for banks. You see, most economies nowadays rely on a fractional system of banking. This means that banks don't hold all their deposits on hand. They only hold a small amount of total deposits, like 20%. The rest they lend out. This is how banks make most of their money. However, most have a set percentage of deposits they need to hold in liquid form, and this is to limit the risk of financial volatility in times of crises. Now, the PBOC has just reduced this number, which is the reserve ratio requirement, by 0.5%. That might sound small, but that translates to billions of dollars of liquidity that banks can now lend to people who will either spend or invest it. This is also bullish for equities. A third action, and this is one that may resonate with a lot of viewers, is the reduction in the mortgage rate by an average of 0.5 percentage point. This again sounds small, but if you think about how crucial the property sector is to the Chinese economy, it doesn't take a genius to figure out that a lot of liquidity that would otherwise be tied up in mortgage payments has just been freed up. And if that wasn't enough, the Chinese central bank has just earmarked at least $71 billion to go towards buying Chinese equities. Yes, the Chinese central bank is buying stocks. That is one of the more extreme examples of quantitative easing. In fact, the Bank of Japan started buying Japanese equities way back in 2010. It is now one of the biggest holders of Japanese stocks in the world. Could this be replicated in China? Well, we're about to find out. For now, all I can say is that if the central bank is a buyer of equities, it can only be bullish. So that's the monetary side. Let's talk about some of the fiscal measures that the Chinese authorities have announced. First, not only did they receive a reserve ratio cut, which will free up a lot of liquidity, banks will also get an injection of capital from the government. Now, this hasn't been announced yet, but rumors seem to suggest that it could be as much as $100 billion. The significance of this is that it'll shore up confidence in the financial sector, which is the center of every economy. Another fiscal action is the issuance of sovereign bonds, approximately $287 billion worth, which is basically raising capital by selling bonds to usually foreign investors. This will give the Chinese government a war chest of cash, which they can use on things like welfare. Yes, the CCP has announced they'll be handing out stone cold cash to those suffering from extreme poverty, and the central government has given directives to their local authorities to ensure the money reaches the qualifying people before the National Day holiday in the first week of October, which is next week. This is probably only going to add up to a couple of $2 billion, but there is a chance that these handouts could be extended to more people and also be given repeatedly. These handouts are likely to boost consumption in the short term, which is going to be good for equities, particularly those in the consumer cyclical sector. So we've covered a bunch of stimulus measures, both monetary and fiscal, and it's clear that all of these measures are bullish for equities. But so what? How has the Chinese market responded? Has it shrugged its shoulders and gone back to sleep? Well, no. The response, to put it lightly, has been resoundingly positive. The Chinese stock market appears to have finally woken from its years-long slumber to book some stunning gains. One of the biggest China ETFs, the MSCI China ETF, ticker symbol MCHI, went up almost 20% this week alone. By the way, this was on the biggest weekly volume since March 2022, when Alibaba started buying back its own shares. Adding fuel to this fire are some highly regarded market experts in billionaire David Tepper and star analyst Tom Lee. David Tepper came on CNBC the other day and basically said, "Buy everything Chinese." Listen to this part where he talks about the PBOC buying equities.
There are also, believe this or not, swap facilities to buy stocks. Encouraging buyback of stocks. Encouraging buybacks of stocks. Okay, this is China. All right? This is stock buybacks. Not only encouraging it, lending you money to do it. And they're giving money like TELF money where you can put money out and you have no losses. If you want to do it, you know how that thing works. You have only the money you put up, and you don't lose money. That's a great deal for me. I want to be over there and borrow for some of this stuff.
Now, this guy's literally worth billions of dollars as a hedge fund manager. He also sports some pretty good returns. I think it's in every investor's interest to at least hear what he says, even if we don't fully agree. In this case, I pretty much agree with everything he says. Furthermore, Tom Lee, who is one of the best Wall Street strategists out there, agrees with Tepper. Watch this snippet of his appearance at the Compound YouTube channel over the weekend.
I would love to hear if you think the buy everything call, not if you think that's what people should do, but like, do you kind of get as excited as it seems David Tepper did?
Our stance at Fundstrat is to treat it like a real move.
Okay.
So we did a webinar yesterday for our clients, and Mark Newton really pointed out this is actually a pretty significant breakout because we've moved to levels that you would expect a much bigger retracement. And he was talking about how many of these stocks then kind of approach multi-year highs. So
Chinese internet stocks, I'm guessing?
Yeah, like KWeb or
Holdings.
FXI.
Now, did you catch that last part? He's talking about if some Chinese stocks, in particular internet stocks like Alibaba, manage to retrace back to their all-time highs, that would be a huge risk to reward trade. Think about it this way. You've got a 50% stop loss if you put it below the all-time low or local low here, and then you've got about a 200% gain all the way up to the all-time high. Now that is a 1 to 6 risk to reward ratio. I'm not saying that it's going to be a successful trade, but it sure does look pretty appealing to me from an investor's point of view. Which brings me to my final segment, and that is my favorite Chinese stocks right now. And of course, my first pick is Alibaba. Why? It makes up a large portion of China ETFs like the MCHI and KWeb, and if the PBOC does buy equities, it'll probably buy ETFs that hold mega caps like Alibaba, which in turn means that the central bank and other institutional investors will be plowing billions of dollars into Alibaba in the next 12 months. Another reason is that Alibaba, like many other Chinese stocks, have formed a technical bottom. I've been bullish on Alibaba since May if you look at some of my past videos, and I believe that this round of stimulus measures is just icing on the cake. And this breakout recently is basically just confirmation. Another Chinese stock I like is Xiaomi. It's one of the biggest smartphone brands in the world and is growing revenue every year by taking market share from the big dogs like Apple. And it's also printing money hand over fist, as you can see by the cash the company has been accumulating over the past few years. And just like Alibaba, Xiaomi is starting to buy back its own stock, which is always a bullish sign. Also, the chart is looking very strong with a definitive breakout on high volume. It also started rallying before this round of stimulus, which leads me to believe that it already had strong tailwinds for valuation expansion, and this is just more fuel for the fire. My final stock is Zijin Mining. I'm a copper bull, and I believe this copper gold miner is one of the best mining stocks in the world. It has some world-class mine and is managed really well, which has set the company up to reap the benefits of the coming rally in copper prices. That's right, I believe the rally in copper is currently reigniting, and this is just the beginning. In further support of the stock, the chart looks very tasty indeed. It looks like Zijin recently broke out of a 3-year base, retraced, and is now ready to go up again. So that's it, folks. I firmly believe this China rally is legit, and I am participating in it mainly through Alibaba shares. Do you own any Chinese Hong Kong stocks? And if so, which ones? Let me know in the comments below, and if you haven't already, please hit the like and subscribe button to get more videos like this one. And until next time, thanks for watching and take care.